Welcome back. Today, we are talking about the true end state of the AI investment boom and why the smartest money in the market is betting on something you might not expect: memory. We are undergoing a massive transition from buying software to subscribing to cognitive compute. Just as we moved from buying physical landlines to subscribing to ubiquitous cellular data, AI is becoming a non-discretionary utility. We are shifting from software as a service, or SaaS, to workforce as a service, or WaaS. Soon, instead of paying for a seat in a software suite, you will pay for task resolution and delegation. So what does this 2030 end state look like? According to late 2025 reports from Counterpoint Research and projections from AMD's CEO at CES 2026, we are looking at a floor of 5 billion monthly active AI users by 2030. This effectively merges the global AI user base with the worldwide smartphone user base, making AI a system-level layer integrated into every device. To serve these billions of users, the hyperscalers, specifically Microsoft, Google, Amazon, Apple, and Meta, are becoming the new Intelligence Telcos. The barrier to entry has shifted to physical reality, favoring these titans who own the full stack of custom silicon, energy, and foundational models. Users will likely pay tiered intelligence fees to these providers, with the average revenue per user, or ARPU, projected to be significant, like the automotive sector's projected AI infotainment ARPU of nearly $480 a year by 2030. This creates incredibly stable, high-margin cash flow businesses. But here's the core bottleneck driving the entire market, and why memory is now viewed as the fiber optic of AI. Every single AI account requires a structural commitment of roughly 3.5 gigabytes of physical memory. This is split into two critical parts. First is the passive footprint, which requires 1 gigabyte of NAND storage. This acts as your digital twin in cold storage so the AI remembers you. It contains about 250 megabytes for your personal context in a vector database, 35 megabytes for a personalization adapter to capture your writing style, and 500 megabytes of raw interaction logs. Second is the active footprint, which requires 2.5 gigabytes of ultra-fast HBM or RAM. This is the working memory, or KV cache, that the data center must instantly allocate to hold your 128,000 token context window the exact second you start a session. And here's the ultimate investor moat. Because your AI provider holds your 1 gigabyte digital twin, switching AI providers will be harder than switching phone carriers. The churn will be incredibly low, making these the most valuable cash flow businesses in history. This brings us to the demand gap, or what we call the Cognitive Contention Ratio. Right now, our global infrastructure has enough NAND storage to host the digital twins of about 2.28 billion accounts. However, we only have enough high bandwidth memory to support 600 million concurrent active sessions. This creates an oversubscription ratio of nearly 4 to 1. It's exactly why we see wait lists today. Providers have the storage to keep your digital twin alive, but not enough HBM to let everyone be brilliant at the same time. If you're on a free tier, you get pushed into low priority queues, but if you pay the $30 to $50 monthly subscription, you are guaranteed a dedicated 2.5 gigabyte HBM slot. To bridge this gap and hit the 2030 goal of supporting 2.28 billion active sessions simultaneously, the industry needs a staggering 7.98 exabytes of dedicated AI memory and storage. Supporting 2.28 billion active sessions out of 5 billion total users gives us a 45% concurrency ratio. This is massive overkill compared to traditional internet providers who operate at a 20 to 1 or 50 to 1 ratio, but it represents a gold standard experience for an AI utility. Because of this, we are in a massive memory supercycle. High-density hardware is becoming the new standard. Data centers are standardizing on the Micron 6550 Ion 30.72 terabyte SSD for passive storage and outbidding other industries for 128 gigabyte DDR5 ECC RAM modules, which currently cost nearly $4,900 each. This insatiable demand is why stocks like SanDisk, Micron, and SK Hynix are seeing record parabolic highs in early 2026. However, there are two major risks to this massive bull case that every investor needs to watch. The first is the power wall. There's a growing concern that the global grid will hit an electricity limit, specifically a 50 gigawatt shortfall. If data centers can't find the power, the number of sessions will be capped by electricity, not silicon. The second risk is the software bear case. One-bit models like BitNet. These architectural breakthroughs could reduce memory needs by 30 times. While this could burst the current hardware bubble by shrinking the active footprint, it could also act as a massive growth enabler, allowing our current 2030 capacity to support over 10 billion accounts. We are literally building a global cognitive grid. The companies that own the memory, the custom silicon, and the power are going to dictate the future of human productivity. What do you think? Will we hit the power wall first, or will software efficiency save the day? Let me know in the comments below, and don't forget to like and subscribe for more deep dives into the Augmented Equity Playbook.